Understanding Reinsurance Ceded, an in-depth overview. Reinsurance ceded is a fundamental concept within the insurance industry, allowing insurance companies to effectively manage risk. By passing portions of their risk to specialized reinsurance companies, primary insurers can create a more stable financial environment while still meeting their clients' coverage needs. In this article, we will explore what reinsurance ceded entails, its benefits, challenges, regulatory landscape, and the various types of contracts involved. What is reinsurance ceded? Reinsurance ceded refers to the practice where a primary insurer, known as the ceding company, transfers a portion of its risk to another insurance company, the accepting company, commonly called the reinsurer. This dynamic enables insurers to limit their overall risk exposure, thus safeguarding their financial stability against catastrophic claims. The mechanics of reinsurance ceded. In this contractual agreement, the ceding company pays a premium to the accepting company in exchange for taking on specified risks. It often relates to high-stakes scenarios such as natural disasters, where the potential financial burden could likely overwhelm the primary insurer's resources. Key terminology. Ceding company, the primary insurer transferring risk. Accepting company, the reinsurer accepting the risk. Ceding commission, a fee paid by the accepting company to the ceding company for covering operational costs related to the reinsurance. Benefits of reinsurance ceded. 1. Risk management. By spreading risk among multiple insurers, the ceding company can minimize its exposure to significant losses. 2. Lowered premium costs. Sharing risk allows insurance companies to keep premium rates more manageable for clients, making insurance more accessible. 3. Increased capacity. Insurers can take on a more extensive range of policies and higher volumes of coverage without sacrificing their solvency. 4. Stabilized earnings. By offsetting significant claims through reinsurance, insurers can maintain more consistent earnings and safeguard capital reserves. 5. Administrative relief. Clients benefit from reduced administrative burdens since they only deal with the primary insurer, even though coverage is shared. Types of reinsurance contracts. Reinsurance ceded contracts fall into two main categories. 1. Facultative reinsurance. In a facultative reinsurance contract, each risk is negotiated on an individual basis. The reinsurer holds the right to accept or reject specific risks, allowing for a tailored coverage solution. 2. Treaty reinsurance. In a treaty reinsurance contract, a broad agreement is established covering multiple risks. For instance, a primary insurer might cede all flood-related claims to a reinsurer. This type provides greater efficiency through comprehensive coverage. Major players in reinsurance. The global reinsurance landscape is dominated by a few major firms known for their innovative approaches to risk management. Notable reinsurers include Swiss Re Ltd. Berkshire Hathaway Inc. Munich Re Group, the world's largest reinsurer, boasting approximately $43.1 billion in net premiums as of 2022. Reinsurance Group of America Inc. These entities often specialize in specific types of coverage or geographic areas to maximize efficiency and expertise in handling risks. Challenges in reinsurance ceded. Despite its numerous benefits, reinsurance ceded is not without its challenges. 1. Complexity of contracts. The negotiation process for reinsurance contracts has become increasingly intricate, with large insurers managing thousands of agreements concurrently. 2. Technological limitations. Many insurance firms struggle with outdated data systems that cannot efficiently handle the complexities of modern reinsurance needs. 3. Unpredictability of catastrophic events. The occurrence of unprecedented events, like the COVID-19 pandemic, has created unforeseen challenges for reinsurers, particularly those specializing in sectors like travel and conventions. Regulatory environment. In the U.S., the insurance industry is predominantly regulated at the state level. This confers varied responsibilities and requirements for compliance. Reinsurers need licenses to operate in multiple states, though they face less stringent regulations than primary insurers due to their indirect relationship with policyholders. Frequently asked questions. What is the difference between reinsurance ceded and reinsurance assumed? Reinsurance ceded refers to the portion of risk that the primary insurer passes to another insurer. In turn, reinsurance assumed is the acceptance of this risk by the accepting company. What is a ceded loss ratio? The ceded loss ratio indicates how much risk, and consequently premiums, an insurance company is transferring to reinsurers. It is calculated by dividing the losses paid out by the premiums received and is expressed as a percentage. A low ceded loss ratio can indicate that an insurer is retaining more risk, while a high ratio signifies significant risk sharing with reinsurers. Conclusion. Reinsurance ceded is a vital mechanism for ensuring the stability and sustainability of the insurance industry. By understanding its nuances, benefits, and challenges, both industry professionals and clients can navigate the complexities of insurance coverage more effectively. This intricate interplay between ceded and assumed risk highlights the dynamic nature of the insurance landscape, where adaptability and expertise are crucial for managing ever-present uncertainties.